Hey, I'm Trey. I'm on the capital markets team here at Finley. Previously, I was in the banking world at Goldman Sachs. Finley is private credit management software that helps corporate borrowers and lenders automate things like financial reporting and their funding operations. Today, we're super excited to be joined by Libby, managing partner and CEO of hybrid investment firm Upper 90. Billy, it's great to have you join us, man. We'd love to get started to hear a little bit about your background and then maybe what makes Upper 90 a unique investment firm.
For sure. In terms of my background, I also was at Goldman Sachs for the majority of my career in quantitative trading. And that was a very formative time because you're figuring out how to use data to price risk and then use technology to do a lot of little events effectively. And if we look at the way the private industry is traditionally financed, it's very much an equity-led story. You know, if you're a hammer, everything looks like a nail, and VCs have really controlled that capital market strategy for startups. And so when Jason Finger, who started Seamless, and me teamed up, we said, hey, how do we think about taking my background in quant and bring that more efficient capital mindset to the startup world, where Jason bootstrapped Seamless and did it in a very founder-friendly way.
Love that. Always great to meet a fellow Goldman alum too. So I guess piggybacking off that, why do you think hybrid credit matters? And then off of that, how has the market validated this approach?
So hybrid credit is a term that we came up with. I don't know if it's the right term. I'll explain what I think it means. I think it means two things. One, we think that credit needs to be a bigger part of the balance sheet for startups. And the traditional way that credit was made available is by underwriting venture capital equity. So if you raise this much equity from this group of funds, we will give you 20% of that in debt, almost like an insurance policy. The problem with that is the only way you can continue to get debt is if you raise more equity. And so I think that founders after a Series B have sold the majority of their company. And so when I think of hybrid credit, it's two things. One, can we underwrite assets that we think credit can be used for, and those assets can pay back the credit? So regardless of raising more equity, you should be able to raise more credit based on the assets that we are financing. And often that could be equipment or inventory or, online businesses that have EBITDA. And I think that just gives you a healthier debt to equity ratio. The other thing is, if I was starting a company, I would demand that my lender had equity in the business. So as a hybrid firm, we only invest in businesses where we think that there is an asset that can pay back the debt, and it's a business that we are excited about. And so that's what hybrid credit means, that we do 90% credit and 10% equity. And it creates an alignment with the company succeeding versus most lenders ask for warrants and they have no skin in the game and they can often make more money when you lose. And so I think that's where Jason and I felt we wanted to be a partner that did equity and debt, but in the right balance to founders.
Love that. Have you seen pretty diverse groupings of companies and businesses that have come to you guys from the hybrid side, or have you seen it pretty secularized in a single industry?
You have to be disciplined about credit. As a firm, we have over 20 people. We have over $1 billion of AUM. We have 50 portfolio companies. Each deal is a bit bespoke. To paraphrase Jason Gus from Octane Lending, he says every startup that is more capital intensive should have Upper 90 in the balance sheet, because you always have part of your business that is better collateralized or healthier. So I think that we really have tried to be a problem solver for companies that have some capital intensity. That doesn't really work for like high margin, low capital, like software businesses. But, if you're buying YouTube channels, or you're rolling up Amazon stores, or you're buying used cars to sell online, or you're buying Caterpillar generators to power a data center, you can kind of go pretty far. And there's a lot of use cases that make sense.
Yeah, that makes total sense. So I guess how do you as an investor decide which companies are worth investing in and which to kind of stay away? You kind of touched on it a little bit, but maybe dig in a little bit deeper there.
The first, if they're using Finley software, that first, but
I agree.
I think the first thing is we don't want to be like the first. There is a role for equity. Like if you're starting a business, that's usually an idea. You're betting on people. You're proving the concept. What we often find is that Series A is like the most dilutive round. If it's working, you go and raise like a pretty material up round, and the VCs have gotten so big that it's not worth their time unless they own 10% or 20% of your company. And so it's kind of like, hey, you've done the seed round. You're proving the concept. Now you want to go to city 3, 4, 5, or go to customer 4, 5, 6, or go from buying 1,000 cars to 5,000 cars, or you name it. And I think that we can kind of help you. We almost say like delay your A or delay your B. So it's like you can go and continue to grow with us without raising half of the equity.
Yeah, no, that makes total sense. So shifting gears a little bit, what does a day in the life of an investor look like at Upper 90?
So we have 4 areas of our business. We have an investment team, which is underwriting opportunities, to make sure that the credit is credit and not equity risk. For example, somebody a couple years ago said to us, will you loan us money against our basket of crypto securities? Or will you loan us money against our baseball cards? Or will you loan us money against a cannabis grow facility? And all of those things, they could be worth 0 as well. And so it's just trying to find how to stress test what is kind of the residual, what is the true value of an asset. And then I think that a big part of our team, which I'm very proud of, is like we take an equity-oriented mindset. So we want to help founders own more of their company through credit. But, the last company that we financed in Seattle, we helped them hire their CFO. We're doing senior secured credit, but there's a haircut piece. We're actually helping them find the haircut capital from more of a friends and family. One of our companies in Texas, they wanted to preserve their equity for haircut capital. We were able to get them connected to Euler Hermes to get an insurance policy as first loss capital. Like because we have that equity alignment, we think and act very differently. And so, Jason and I joke, like our capital's greener. Like we add all the value that a VC would add, but you own twice as much of your company if you work with us.
Yeah, I mean, instead of being a debt collector, you're a true partner.
The thing I don't like about credit is your best credits want to get rid of you to get cheaper capital. We don't lead deals. We want to be like number 1 at being number 2. So we're incentivized to help get you to bank financing. Don Muir said this, who we respect a lot from ARC. A lot of times founders thinking about their first facility think about how big of a facility can I get and how cheap can that facility be. You want a partner who's going to be your best partner for this stage of your business. We care about that first facility. We're not trying to get the 3rd and 4th facility. So I think a lot of people are actually going to people who can stroke bigger checks, but they're actually taking away optionality and flexibility, which is the most important things when you're a startup, not the cost.
Yeah, and I think that first partner is pretty crucial to make it to that 2nd, 3rd, or 4th facility, because if you're 100%. Not starting right from the get-go, you're set up to fail.
And most of them people don't have a CFO, and so how do I think about getting audits and tax and liabilities and all the things you want to have in place? A lot of what you guys are doing at Finley too is to help democratize, the services that a startup wouldn't have that you would have at a big bank or enterprise company.
Given the current state we're in today, how has the debt capital landscape changed in your eyes over the last 5 years?
So I think when we launched in 2018, it was very much why credit? Because equity was very cheap. You kind of look at your alternatives and say, okay, I could get a VC or a growth or a crossover fund and they'll just add a 0. So I don't think founders really thought about credit because equity was very inexpensive. And I think today it's expensive and founders are thinking, what are ways that I can grow without having to do an equity round right now? It shifted from like why credit 3 or 4 or 5 years ago to like why Upper 90 versus another credit firm. So that's one. Number 2, one of my favorite investments that we made is a company called Coastline. And for many people listening on this call, I think that because equity was so cheap and because VC AUM has grown so exponentially, kind of at exit, the management and founding team owns less than 10% of the business. After the Series B, you own less than half. So I think it gets worse. And now there's all these pref shares and no one thinks about this. So your only option as a founder is like unicorn or bust. And so Coastline basically, they're building a tech-enabled driver's education school. So very profitable business, tech-enabling a historic government-mandated program that's private industry franchise model. They're scaling profitable, and their biggest expense is a Toyota Prius to lease and to buy for the drivers. And because they luckily found us through one of their LPs before they raised this very dilutive and permanent equity round, they were able to get financing from us for the cars. They were able to raise about a quarter of the equity that they would have normally raised. They had an exit to private equity, but because they owned 80% of the company, they would have made as much as if they had a unicorn business. And so I just think a lot of founders now are like, growth at all costs is probably not a good idea because I have one option. I think in life, you want to have diversification and optionality.
Being in the bull market that we were in for so long and having shifted over the last year into the bear market we're starting to see, obviously there's natural correction that's going to occur. What are the expectations you think for this level out and plateau that we're kind of hoping for in the debt space?
So, someone said to me, it's a 10 out of 10 market for private credit. I think that there's room in everyone's portfolio as an investor to get mid-teens unlevered senior secured return. Now, a question is why would somebody listening here pay mid-teens interest? And I would ask them, what is the cost of equity? And credit's temporary, equity's permanent. And, what's the cost? But I just think no one's really what is the cost of equity? And so I think you're going to see debt coming in much earlier. I think a big thing now is that late stage companies and mid-stage companies and early-stage companies are all going to have capital markets challenges. So our last deal was a company called FilmRise, which I consider to be a pre-IPO company that had a short-term capital need. And it was going to be kind of too long for banks to underwrite. They didn't want to get locked up for 5 years with a traditional credit fund. And so we did a 1-year senior secured deal that would never have been available in a flush market. So I think everyone had to go early to get into deals. And now I think you're going to see all companies having kind of short-term capital needs. And then I think you're going to see a lot of new founders coming out that are second and third time founders saying, I just care about how much I own. I really don't care who my capital comes from.
It's interesting to think about looking at the fintech world in particular, reached a pretty all-time high in 2021 and has taken a pretty big hit ever since. Do you think it's going to make a comeback? If so, where do you think that's going to be focused on?
Sure. So, we've seen this playbook, right? Fintech 1.0 was the lending clubs and the Prospers, and Fintech 2.0 has a lot of these MCA products like the Clearbanks, the Pipes, the Arcs. I think the biggest challenge, even you see this now with Goldman and Marcus, Fintech is about sales. Can you cost effectively acquire a customer? I come from quant trading. There's no magical underwriting. And so you spend your money to get the customer and the data. And the problem is in those two situations, all their margin is customer acquisition. And then standards loosen because you want to get more customers. So I think Fintech 3.0 is what we're excited about, which is more vertical Fintech and it's vertical SaaS. There's software that's now going to help laundromats go online. League Apps is a company I'm an investor in. They are the software platform for youth sports, which is an enormous industry. So I think all of these, vertical businesses, of which there's many, I think all of that is very exciting to us because those are embedded customers and they don't really have financing yet, versus we're going to have a better credit card than Amex and we're going to, have a magical way of looking at FICO, and that doesn't excite me. It's like boom or bust business.
Right. Yeah, no, I totally agree. Why do you think that there's so little information transparency when it comes to capital strategy for startups? I feel like that there's a bunch of different routes companies could go with little direction sometimes.
That's part of why we're doing this now. I think a big part of it is awareness. We are very passionate about getting in early and helping play this role. but it extends beyond the credit. So for example, if you polled all startup founders and said, what is QSBS? Probably a majority would know what that is. It's a tax exemption. And then my partner, Jason's obsessed with tax. And so he said, okay, well, did you know that you can set up 5 trusts and get 5x your QSBS? Most founders don't know that. And so I just think that a lot of this is just, people think about estate planning and credit and balance sheet like after they've had an event. We want to challenge growth equity in venture capital, and you just need less equity. And I don't think founders think about a lot of this stuff until like after they have an event, and you can't undo that.
So I guess now some more fun questions. Can you kind of talk through how you came up with the name Upper 90?
It's the top corner of a soccer goal. So I played soccer in college, and, the top corner of a soccer goal is like these niche-y, hard to hit areas. And, our first slogan we started Upper 90 was above market returns from below the radar opportunities. It's kind of like finding these niche and special sits. And now it's just like, it's not how much you raise, it's how much you own.
Talking back, you mentioned being a working parent. That's awesome. A little personal advice. I'd love it. I'm actually wife and I are expecting a baby here this month. So any parenting advice would be great on being the working parent.
We actually had 2 people on our team get married recently. So everyone went around and as we get older, gave some marriage advice. First of all, congratulations. I would say a few things. 1, get a baby nurse, like 100%. Number 2, when you have your first child, I think the inclination is to have like your parents and your relatives and your friends and like everyone, you're very proud and it's new and it's like you almost feel like you need to let them all come. I think it overwhelms your spouse or your partner, and just like limit the number of guests and focus on kind of getting back to normal, and like they can come and visit the baby like after month 1 or 2. Right. Those would be the two major things.
That's awesome, man. Well, thanks a ton. I wanted to say thanks again for your time. And to all our listeners, if you'd like to learn more about Upper 90, you can visit upper90.io. And if you want to learn more about Finley's credit facility automation software, please check out finleycms.com.